An equity-linked swap, ELS, is a financial derivative contract that allows investors to exchange the returns on a fixed income security for the performance of a stock or equity index. In other words, it's a type of swap where one party agrees to pay a fixed rate of return on a notional amount of money, while the other party agrees to pay a variable rate of return that is linked to the performance of a specific equity or equity index. The fixed rate of return is typically based on a benchmark interest rate, such as LIBOR, while the variable rate of return is based on the performance of the underlying equity or equity index. If the equity or index performs well, the variable rate of return will be higher than the fixed rate, and the party receiving the variable rate will benefit. Conversely, if the equity or index performs poorly, the fixed rate will be higher, and the party receiving the fixed rate will benefit. ELS contracts are commonly used by investors who want exposure to equity markets but want to limit their downside risk. They are often structured in a way that provides some protection against market downturns, such as a cap on the variable rate of return or a guaranteed minimum rate of return. As with any financial derivative, there are risks associated with ELS contracts, including counterparty risk, market risk, and liquidity risk. There are several risks associated with equity-linked swaps, ELS, that investors should be aware of, including market risk. The performance of the underlying equity or equity index can be volatile, leading to fluctuations in the variable rate of return. This risk can be hedged by using options or futures contracts to offset the exposure to the underlying equity or index. Counterparty risk. ELS contracts are bilateral agreements between two parties, and there is a risk that one party may default on their obligations. This risk can be mitigated by using credit derivatives, such as credit default swaps, to transfer the risk to a third party. Liquidity risk. ELS contracts can be illiquid, meaning they may be difficult to sell or unwind before maturity. This risk can be managed by selecting a contract with a liquid underlying equity or index and monitoring market conditions closely. Interest rate risk. ELS contracts often involve fixed interest rate payments, which are subject to interest rate risk. This risk can be hedged using interest rate swaps or other fixed income instruments. To hedge these risks, investors can use a variety of financial instruments and strategies, depending on the specific risk and the investor's risk tolerance. Options, futures, swaps, and other derivatives can be used to offset market risk, interest rate risk, and liquidity risk. Credit derivatives, such as credit default swaps, can be used to hedge counterparty risk. It's important to note that hedging strategies come with their own risks, and investors should carefully consider their risk tolerance, investment objectives, and financial situation before entering into any derivative transactions. It's also important to seek advice from a qualified financial professional before making any investment decisions.